Welcome to the last session of the day. It seems to show in the number of participants as well. Today I'm going to talk a little bit about decentralized finance for Bitcoin and then how the project we're working on ties into that. We'd like to demonstrate a bit of how we see the market developing specifically with regards to Bitcoin, and then hopefully you guys can challenge our hypothesis. That would be success in my mind if we can get some good feedback. So my name is Ilan Nahari. I run partnerships for CementDAO. And one of the things we've been looking into, and a little later on I'll get into what CementDAO does and how our protocol plays into stablecoins specifically and for Bitcoin. One of the things that we've been focused on is how the DeFi space connects with Bitcoin and how really to utilize this asset as a reserve currency for decentralized finance. And so even though the name of the session is called DeFi for Bitcoin, it's a bit of an oxymoron in a way, because Bitcoin in itself is the biggest, the largest, and the most successful decentralized financial application that's ever existed. I read a nice sentence on Twitter recently. A lot of people talk about how Bitcoin is here to bank the unbanked, but what has actually happened over the last few years is that Bitcoin is starting to unbank the banked. So we're seeing a situation where more and more people are turning to Bitcoin to use it as a store of value and as an alternative asset that they can use to hedge against whether macro trends, whether it's inflation in fledgling economies, or just generally as an investment tool against macro trends where we're seeing that bonds are yielding negative interest rates, or other assets such as real estate or stocks, which are currently sky high. So there are two slightly different use cases, one in the more developed economies where people are using it as a store of value, and other in struggling economies where people are using it as a way to circumvent capital controls, a way to hedge against inflation. But in essence, what we have is an asset worth around $200 billion and has essentially grown to such an extent in 10 years and is a decentralized financial protocol. But going back to DeFi and kind of what the topic of conversation is in this summit, DeFi is, when you think of DeFi, you think of Ethereum. That's where most of the use cases are. That's where most of the usage is. That's where the development is. And we see that a few months ago at its peak, DeFi was capturing close to 2% of ETH that were locked in different protocols. And we're seeing more and more use cases. I learned a lot over this last day, I'm sure tomorrow, a lot of new protocols, a lot of new development around additional use cases for leverage, credit derivatives. A lot of different use cases that take out central intermediaries and utilize code to provide rules and maybe even more importantly also anticipated consequences for financial transactions. Currently, last I checked, there were about $500 million locked in DeFi. And like I said, the majority of the focus is on Ethereum. But when we look at Bitcoin, what we see is an asset that is currently growing in its dominance compared to other cryptos. It's by far the most liquid asset. It is by far the largest asset. It is by far the most decentralized asset. And maybe even more important than all of those, or as a consequence of all of those, the most familiar cryptocurrency in the world. And what we'll get to soon is, what does that mean for DeFi and Bitcoin? What is that likely to look like? when we look at all of these characteristics and we see that they hold such immense potential. But taking a step back, what we need to realize is that there is still very little kind of traditional DeFi activity on Bitcoin. The majority of the activity is centralized finance. So a lot of companies, a lot of intermediaries are providing services such as leverage, through Genesis Capital, who have already, over the course of 2018, have lent out over $750 million. Players like BlockFi, Unchained Capital, giving holders of Bitcoin the ability to take out loans and earn interest on their Bitcoin holdings. We're seeing all the major exchanges now providing margin trading, such as Kraken, BitMEX, Bitfinex, and others. Even though these specific products have their own limitations, which any centralized service is going to have, and that is around regulation and jurisdictional limitations. Another interesting use case that we see on Bitcoin is Tether. So obviously Tether was initially launched on Omni, but is now also being minted more and more on Ethereum. But Tether is an interesting case because it is the most dominant stablecoin. It is a stablecoin that is now around $5 billion. And that was originally based on Bitcoin. But there is a fair amount of activity happening on Bitcoin. And there are many different avenues in which developers are trying to provide DeFi for Bitcoin. And maybe it's worthwhile talking a little bit about why we didn't see the explosion of DeFi on Ethereum. Why didn't we see that happen on Bitcoin? So I think primarily this is a consequence of one simple thing, and that is Bitcoin's programming language. It took a totally different focus, which was one of security and stability, whereas Solidity on Ethereum obviously provides you a lot more functionality, a lot more flexibility to provide different functionality. And that's really what the core of DeFi is. It's the programmable money. But we're seeing a few advances that are happening now. Some have already been released, but a lot are still in different stages of development. And they revolve around what we think are probably the main pillars of DeFi, which are decentralized exchanges, stablecoins, and other trading protocols. But in terms of DEXs, we're seeing interesting developments such as Arwen, which are working on on-chain escrow and atomic swaps based on hash-time block contracts. We're seeing it with Suma, who are developing stateless SPV, which is a very interesting technology that will allow you to verify the state of Bitcoin with Ethereum contracts. BISC, which is a DAO that's launched a decentralized exchange. We're seeing work on federated sidechains. I think probably the most notable are Liquid and RSK. RSK is an interesting example because they are a smart contract-based protocol which is fully compatible with Solidity. So potentially what we could see there is the porting of a lot of the DeFi projects that we're learning about here that are already very popular, such as Compound and Maker, porting themselves onto RSK, and we're already starting to see this happen a little bit right now. Other interesting solutions that are being developed are layer 2 solutions, which are really trying to strike at the payment use case, in particular the Lightning Network. And we already have seen other implementations such as Wrapped BTC. That's a typo, by the way. There aren't 5,000 BTC WBTC that have been minted. It's only around 570. Cosmos Zones is an interoperability solution which is being implemented. And lastly, for stablecoins, we have Money on Chain, which are set to launch the first Bitcoin-backed stablecoin by the end of the year. But looking at all of these developments, one thing becomes clear, and that is the real importance in DeFi is the aspect of removing intermediaries. And a lot of these solutions they either make certain trade-offs which keep a reliance on a certain set of validators, and that is in particular very problematic when it comes to federated sidechains, which can provide a lot of additional functionality to Bitcoin without changing the base protocol and security that it provides, but again relies on federators and relies on hash power provided by miners. Similar problems we see with the Lightning Network, for instance, and with other solutions that are being implemented on Bitcoin. So one of the questions that comes to mind is how are these problems going to be tackled? And the reason this question of DeFi and Bitcoin interests us so much is from two aspects. One, as we've been working in the space for many years, really focused on mass adoption. How do you bring crypto to the masses? How do you take it out of the use case of trading and speculation, which is 99% of what it is today? And the second would be, as Bitcoin enthusiasts, how are we able to leverage our Bitcoin as hodlers without compromising on custody? So what are the solutions that can be provided that give us on-chain certainty without having to relinquish any security, but also still leverage our Bitcoin holdings? And there's this famous meme that hodlers have of when are you going to sell your Bitcoin? And essentially, I'm never going to have to sell my Bitcoin. A lot has to happen for Bitcoin to reach that point, but we think that one of the main pillars of that is a smarter Bitcoin, a Bitcoin that can leverage all of the functionality that DeFi can bring. Obviously, there's a reason we haven't seen an explosion of DeFi on Bitcoin just yet. There are many challenges, and I think one of the main ones I've already touched on, and that is the limitations of script and the difficulty in providing programmable smart contracts onto Bitcoin. But beyond that, there are other risks that are apparent in different solutions that people are proposing. And one of the things about Bitcoin which makes it so successful, also in terms of retail investors and also in terms of institutional investors, is the certainty it provides, the decentralization it provides, both which augment its security. So anytime you make a trade-off and you minimize one of those aspects of Bitcoin and you try to rely on either side chains that have less hashing power or solutions that require or just are able to run on a small set of validators, you're making a very difficult trade-off for Bitcoin holders, which may be different for people who are trading on Uniswap on Ethereum. So there's that centralization risk, which is apparent in all of the different implementations that we've been seeing. Another thing which is not only a problem with Bitcoin, but a problem with many other chains is how do you solve the problem of scalability? I'm sure you're all aware of what these problems are, especially when DeFi relies so much on on-chain validation. And lastly is the matter of issuance. And when I talk about issuance, I'm talking specifically in the use case of DeFi. I'm talking specifically about stablecoins, but similar problems we've seen on any ERC20 issuance on Ethereum. These issuances are centralized a lot of the times. They are bound by regulation. And there is a lot of difficulty for getting institutional players to buy into that or to have the ability in terms of their own internal policies to start investing in these assets. So now I'm getting a bit to kind of our hypothesis at CementDAO and what we're working on. And the way we see it is 2 years ago, the last bull run, I do apologize if it's a little difficult to see, but the last bull run was driven by Ethereum's killer use case. ERC20 standardization. That facilitated a situation where anyone could easily tokenize assets that would run on Ethereum's network, and is what spurred all of the innovation and nearly all of the development on DeFi that we know today. That one simple standardization of ERC20. That was the catalyst of the 2017 bull run. We think that the next bull run is going to be based on a very different landscape, both in terms of the maturity of the crypto space and in terms of the type of investors that we're going to see coming in. And our hypothesis revolves around three main pillars: DeFi, stablecoins, and institutional investors. So why do we think these are the three main drivers? So DeFi, we've been talking about it for the last 10 hours today. We'll be talking about it tomorrow. I think it's relatively clear why there is a need for a use case like this. And that's to some extent not only because of the innovation in DeFi, but really the stagnation in centralized finance. It's excluded all kinds of different use cases. It's excluded all kinds of people. It's excluded a lot of creativity and innovation. And the regulations around it today have created a situation where it's extremely difficult to compete. It's extremely difficult to innovate. And DeFi now is proving to be a very fertile ground for this innovation to come up, for people to realize that there are use cases that they're interested in taking advantage of that were totally closed to them before. We've seen this trend grow. We see no reason why it would not keep on growing and why it wouldn't accelerate. So the bottom line of that is the demand for leverage, demand for credit, which will create a lot of buy-side pressure. The other pillar, which is what we specifically at CementDAO are focused on, is stablecoins. Some people call 2018 the year of the stablecoin, or 2019 the year of stablecoin maybe, because JP Morgan coming out with their stablecoin. Facebook have announced their plans to launch Libra. But in essence, we haven't seen much change in the space. Tether is still the most dominant player. There are additional issuers that have come out. I think what's probably the most interesting stablecoin is DAI because of its decentralized characteristic. But it's very likely that the growth in stablecoins, which is also accelerating and growing at approximately 140% annually, is going to continue simply because of the huge convenience that they provide, the circumvention of fiat on-ramps, and it's very likely that stablecoins are going to be the new gateway into crypto, whereas in 2017, the gatekeepers were exchanges. And once you're able to provide platforms that make issuance of stablecoins very simple, then that gateway can be expanded way faster than a situation in December of 2017 where you had thousands of people waiting to be KYC'd so that they could buy into the bull run. Our hypothesis is that if the fragmentation of issuers of stablecoins continues to accelerate, and it is a basis for issuers such as Facebook and Telegram, and potentially WePay, or all of these large tech companies and financial institutions to start issuing coins, they'll be able to leverage their pre-existing and pre-KYC'd user bases of thousands of people who have USD deposits in the bank and can simply be issued a wallet on their phone with a tokenized dollar. And we think that the market isn't far from that. And if that is aligned together with other aspects of the next bull run, we could potentially see onboarding at a magnitude higher than what we did in a couple of years ago. Lastly, the pillar of institutional players is going to be very interesting because in crypto we've seen an opposite universe in which investors in the space were initially retail investors, and a lot of protocols essentially IPO'd from day one. And smart money has stayed on the sidelines for all kinds of different reasons, but these are changing, primarily around regulation and custody, and also because the ecosystem as a whole is maturing. And we're seeing this, again, with large companies coming into the space, Fidelity, backed, all kinds of new derivatives, futures trading, which are coming online this year and next, are going to more than likely be one of the reasons why the next bull run is going to be very big. So why am I talking about this? What is our hypothesis? So if this is true, then what is holding us back? And I would love to get kind of a read from the room, from you guys. What is the future of DeFi on Bitcoin? What are the barriers that are holding it back? How do we utilize these $200 billion that are, to a large degree, sitting in on exchanges or sitting in cold wallets, with people who are interested to leverage them? What are the barriers, or how come we're not seeing the same type of enthusiasm, perhaps, for DeFi and Bitcoin than we are on Ethereum? So just a quick question from the crowd. How many people here trade Bitcoin? And how many trade Ethereum? And what do you, other than trading or maybe hodling, do you use DeFi platforms? What platforms do you use?
Compound.
So basically, so leveraging.
Yeah.
And you, sorry?
Maker and Compound and Dharma. I experimented a little bit with.
So is it mainly out of kind of a curiosity, or are you using it to basically leverage up your positions?
I used it to unlock some of the value that I had in Ether, but the enthusiasm for that quickly faded away when the stability fee rose dramatically. But it's interesting to use, definitely, to experiment with.
Is anyone here as a Bitcoin holder, have you looked or been curious about options of leveraging your Bitcoin positions? Perhaps on BlockFi?
Yeah, I've used BlockFi for a little bit.
Have you had any?
I wouldn't trust too many of my Bitcoins on BlockFi, but you can definitely put like a little bit of it.
And is your main, what's your main concern about using BlockFi?
Well, it's pretty centralized.
Yeah.
I guess. I mean, if they mess up with my Bitcoins, I know I have a risk of not seeing them back again. So.
I mean, I use BlockFi, but I guess I see the risk a little differently. So they're using Gemini as a custodian, hasn't been hacked for a while, which they can be. But I think the problem is they're lending this out. I don't know who they're lending it out to, and so if there's a massive default on that side, that's like a bigger risk, I guess.
Very little visibility into
who they're lending to.
Yeah. I think, well, for me personally, it's, I consider myself a very conservative investor. Companies like BlockFi have been around for a year and a half, 2 years tops. There's no history behind these companies. There isn't even the same comfort that you can get around, working with a bank that has a federal insurance. And what's interesting about that is that these are products that are aimed for users of Bitcoin who generally are hypersensitive to these things. So it's very hard to see how these systems are going to mature beyond people using small parts of their holdings to lever up. And we're seeing that BlockFi, I think, last I checked, had only around $50 to $60 million in loans, which is impressive. But again, where is that growth going to come from? Especially when you have institutional investors, asset managers who, from a custody perspective and from their own internal policy perspective, will never be able to use these platforms. So I'd like to talk a little bit more in detail around the pillar of stablecoins. So around DeFi, I think in general there's this acceptance that perhaps the biggest blocker for Bitcoin is a good, useful smart contract platform that can be used. I don't know if anyone disagrees with that. Are there any developers in the room? What do you guys develop on? Solidity?
The off-chain completely.
Sorry, can you use the mic?
Sure. Thanks.
I'm not a blockchain developer, so I pass it on to the developer.
I'm just curious to hear if there are any developers who develop on Solidity or perhaps maybe have looked at RSK and why they've made the choice of whatever platform that they have of preference. If there isn't anyone like that, we can just move on.
Yes, I've done some Solidity development. I mean, the reason for doing Solidity is, or EVM more specifically, is of course it's decentralized, right? Deploy code, immutable, so on, all those things. And with regards to Bitcoin, will it ever be able to catch up? Well, I think that depends on the roadmap of the Bitcoin development community, right? Are they going to change the script? Are they going to provide other features that would make this possible? I don't know. Maybe
Do you see a situation where the development of DeFi and Bitcoin is not reliant on script?
I think it needs to be layer one, for sure.
Why is that? I'm curious.
Because why would I trust anything else?
So what about RSK, for instance?
I haven't looked at that specifically, so I don't know.
Yeah, but it could potentially have the same issue where as a federated sidechain, you're relinquishing a lot of the...
Well, anything which is layer 2, say, would have issues, I think, with the network effect, or having it on layer 1. Like we see with Ethereum right now, people are building on Ethereum because everyone else is building on Ethereum, right? And you get this ability to basically have Lego blocks that you can put together and build new things on top of, right? And I mean, sorry if someone disagrees, but I don't think Bitcoin will be able to catch up. But as a store of value, if you could solve the issue of maybe wrapping Bitcoin and using that, if you can find a way of doing that decentralized, maybe that's a potential.
Yeah, I agree with you, and that's kind of a good segue into what we're doing at Cement. I think that script as a programming language does not and probably will never have the flexibility that you need for a smart contract platform. So if Bitcoin is going to catch up, and if you're able to find a way to maybe decentralize centralized inputs, then you're sitting on a store of value, a reserve asset, which in my mind is far superior to Ethereum. And that's kind of what our philosophy is at Cement with regards to stablecoins. So the problem with stablecoins are, and just as going back a second, our general theory is that stablecoins are imperative for DeFi, as obviously I think DAI has demonstrated. But the problem with stablecoins is that they are not interoperable, even though for the large part they do represent the same real-world asset. So, if you're holding USDC and you want to use it on an exchange that only accepts Tether, or you want to use it with a dApp that only accepts DAI, you have to go through one or two intermediaries before you can do that. There's always that counterparty risk, whether it's a centralized stablecoin or a decentralized stablecoin. With DAI, it's the risk around, it's a technical risk, it's a loss of peg risk. With the centralized coins, I think it's obvious. With Tether, for instance, or with USDC or Gemini, the ability to lock your funds if they want to. And lastly, this lack of liquidity that you have with this long tail of stablecoins, which in large part is due to the fact that they're not fungible for one another, creates a situation where you have dominance and all the liquidity concentrated in one issuer, or maybe two or three, but again, that only augments the risk aspect. What if that issuer fails? So what we're doing is we are, on a high level, trying to take centralized inputs, in this case stablecoins, but this can also be applied to other real-world assets that are tokenized, such as bonds, derivatives, equity, to take centralized assets as inputs and create a decentralized system around them. So you can think of it kind of like a Visa or stablecoin aggregator. And what Cement does is it's a DAO. It's currently built on Ethereum and RSK, which does four main things for stablecoins. It provides immediate interchange between them without reliance on any third parties. Quite similar in concept to Uniswap or Bancor, but with the added benefit of much more liquidity, because there isn't this counterparty token that you need to lock in, such as ETH and Uniswap. It provides a protection layer for users in the form of a decentralized marketplace for risk. And we think this is very important because people who use Tether today, people who use crypto in general, have extremely high risk tolerance. And that is not the case with institutional investors. It's not the case with people who have a Monzo account and are interested in using the crypto version of their dollars or their pounds so that they can easily transact with merchants and people across the world. They will never tolerate a situation where if one day their pound is worth £1, the next day it's worth 95 pence, and one day maybe they found out that it's worth 80 because the issuer didn't have the correct audit or had their funds seized by the New York Attorney General. We also think it's extremely important to simplify the experience of using stablecoins. This is a problem that's prevalent around the crypto space, where it's very difficult to onboard users because not only is the user experience very difficult, but also the consequences of making a mistake are much higher than any other technology, consumer technology. And then lastly, we think that this is a system that will grow the crypto system as a whole. So how does it work? If you think of Visa conceptually, all that Visa is a payment network that connects issuing banks, which in the case of stablecoins are the issuers, and it connects them to the merchants and the users. So when you go to a store and you use your Visa card, the Visa network connects you to the merchant bank, the issuer bank, the merchant in your bank account, and provides all of the infrastructure in order to make that transaction seamless. The same is true for crypto. Why don't we have a situation where if I have a USD pegged stablecoin, can't I use it on any exchange with any merchant? Or in the future, perhaps, if I have Facebook coins that are pegged to the dollar, why can't I use them to send money to PayPal or Venmo or to WeChat? Why isn't there this aggregation mechanism in the middle that can sit and provide a aggregated liquidity and immediate atomic swap between these different tokens? We think this is possible only with a DAO. And the reason we think it's only possible with a DAO, or a decentralized smart contract, is that any central point of failure for a system that is aiming to be a global aggregator and payment provider is simply impossible and cannot really provide the type of risk protection or type of decentralization that is required for this to work. The reason Bitcoin is so successful is because it's decentralized. The same will be true for when we want to transact with stablecoins in the future. I think it's very unlikely that we're going to see a winner-takes-all scenario in which a USDC-like company manages to onboard tens of thousands of merchants around the world and is able to apply standards on the issuer level. If standards will ever be applied, it will be a standard similar to ERC20. It'll be on the protocol level. So that's kind of the high level of what we're working on, and how we think that's going to tie in one of the main pillars of DeFi. I'm happy to take any questions if anyone has anything around what we're doing, work we're doing with RSK and CementDAO. So please, if there are any questions.
Sorry. So you got two different types of stable coins. One is maybe Libra or the other one's USDC. You have different supplies. And essentially, they're not, although they're pegged to the dollar, they're
never going to trade one-to-one.
Yes. Mm-hmm. So I don't understand how you match the liquidity.
So what we have is a smart contract that has inputs in the form of these stablecoins. So firstly, not every stablecoin can be allowed into the system. The system has a governance structure around it, which through different mechanisms, which are delegated proof of stake and futarchy, makes a decision as to which stablecoins are allowed in. So it's made a decision that allows in 5 different stablecoins, and for the sake of simplicity, it applies a allocation for each stablecoin. So for instance, you could have a situation where Facebook coin has 20% of the basket, and another coin has, let's say, DAI has 10% of the basket. Now, the way that the arbitrage or one-to-one, or essentially the way the price discovery happens is not reliant on any oracles. The way it works is through a dynamic fee pricing curve. So for instance, if you have an allocation of 20% for Facebook coin, and people have only provided 10% to the system, then the system is going to provide incentives for people to provide more Facebook coin into the system as liquidity. And the way it's going to do that is to make it cheaper to pull out, to trade Facebook coin for any other asset. So if you're an arbitrage bot or you're a trader, you're going to naturally be incented to go to the system, provide it with Facebook coin, and through this dynamic pricing fee, pull out another token, or potentially keep your liquidity in there and get a meta token that you can redeem for any other token at any time. And at the core, what this dynamic pricing fee does is mimic the activity in the market. So it's going to respond to the way people are trading with the system, change the fees accordingly, and provide arbitrage opportunities to liquidity providers.
But if it's like, let's say, let's say Tether is going under,
Mm-hmm.
right? And people are dumping it, and it's in your basket.
It's a very good question.
How would you,
So-
no incentive.
So obviously, again, if you start dumping Tether, then the dynamic pricing is going to make it progressively more expensive to dump Tether into the basket. But again, if Tether is going to zero, people won't care. They'll pay 5%, 8%, 10% just to get rid of it. So at some point, the system hits a circuit breaker, and it totally freezes all trading in Tether. And then 2 things occur. One is that a vote or decision is elevated to the governance level of what do we do? Do we change the allocation of Tether? Do we kick Tether out? Do we change the pricing fee in light of this new market activity that we're seeing? And two, the smart contract is like a CDP with junior holders and senior holders. In the case of Cement, what you have is a class of users called risk holders, and they are users that assume the risk of any of these one inputs losing their peg. So if Tether goes under, they're going to be automatically expelled from the system. So for instance, if they provide DAI to the system in the beginning and Tether goes under, then they are issued Tether instead of the DAI that they provided to the system at first. The reason that happens is now the system has purged itself of Tether, and regular traders, or kind of the senior class, are not affected by that one loss. Again, if there is a black swan event and there are multiple coins that lose their peg at once, that's a situation that the system can't handle. But let's say Tether has 15% of the basket and goes to zero. If there weren't these risk token holders, who, by the way, receive a yield for taking that risk, then everyone in the basket essentially loses 15%. But in this case, only the risk holders take that loss, and everyone else carries on as though nothing happened.
So by providing any stable token to the basket, I assume the risk of all the tokens in the basket?
Well, if you provide stablecoin to the basket, you're given a choice. You can be a senior holder or a junior holder. You can assume the risk if you want, in which case you're getting an ongoing yield for that risk. But if one of the underlying stablecoins loses its peg or is expelled from the basket, you're the one who's going to hold it at the end of the day. Or you could be a regular casual user who just uses the basket for interchange or to diversify their holdings. So say you hold a lot of Tether, you can input them into the system, you get a meta token back that you can either use as a stablecoin or redeem at any time for any of the other underlying stablecoins. And in that case, you're assuming much less risk, because if one of the underlying loses its peg, you're protected. If two or three do, then you're going to take a certain haircut, but it's still a better situation than if you were holding only one of those stablecoins. And so you're given that choice when you provide liquidity to the system. And the system has a mechanism, kind of an ongoing market to make sure that there are enough risk holders in the system to provide protection for at least a situation where one of the inputs or one of the stable coins goes to zero.
So first of all, let me just quickly check if I understand this correctly. So you have a smart contract, essentially, with a bunch of different stable coins put in, and the output of that is a new stable coin, backed by all these other stable coins. And if there's something happening to one of them, then the others have to pay in to compensate for the lack of one of these stable coins. And you say they are compensated by receiving interest on that. So who pays that interest is my question.
So the interest, firstly, the system collects transaction fees. These are fees that are held by the system, and a certain proportion of them are diverted to risk token holders. And in the event that that isn't sufficient, and from what we've modeled, it's an unlikely event, but obviously can happen. It has a similar mechanism to Maker, where the governance token holders are then kind of the risk protection of last resort. So the governance, yeah.
So it's a system of smart contracts operating on Ethereum, and it's a stable coin backed by several stable coins. But initially you talked about backing with Bitcoin, and you can't deposit Bitcoin in this system. So either you take Bitcoin through centralized mechanism, or you take wrapped Bitcoin, and then you still have those trusts. There is a centralization effect somewhere if you want to be exposed to diversify outside the Ethereum DeFi system, right?
So, yes, that's a very good question. One of the things that we're working on is compatibility with other chains. And specifically, what we're doing right now is building a federated bridge between Ethereum and Bitcoin through RSK. Now, obviously, that brings in its own problems, but the idea would be to manage that federated bridge through the through the DAO of the system. So potentially, if successful, we'll be able to achieve, perhaps you could call it a high enough level of decentralization to minimize the risk of that federated bridge. And the idea of how this ties to Bitcoin, and not only Bitcoin, but other chains, whether it's Zilliqa, EOS, or any other one, is that by creating those allocations, what you're doing is you're creating demand for that stablecoin. Because if you have an allocation in this basket for a certain stablecoin, and then you can earn by depositing and that stablecoin for others and earning on that arbitrage potential, you're creating demand from issuers. What we hope to see is that projects that are issuing on other chains, so for instance, money on chain on Bitcoin, would use that bridge in order to issue their stablecoins into the Cement system. Another solution which you could potentially use is to only allow the meta stablecoin that is issued when you provide liquidity to the system, only allow that stablecoin to transition between chains. The advantage of that is that it's a lot simpler and potentially requires much less integration between different chains. But then the only problem is at redemption, you would have to transfer back to the original chain, which in this case is Ethereum. Potentially, if the protocol is successful, then redemption won't be needed nearly at all. You can use that meta token to transact across multiple chains and never have to convert it back into the original or underlying stablecoin. But it's a very good question. I think a lot of people are kind of struggling with it. And
well, just coming back to the previous question on the subordination of basically different classes of holders. So I mean, it touches upon it's a bit on the more technical side, but just from a logical point of view, let's say assuming the junior class holders does not correspond to the so basically, if you have let's say 15% of junior holders, and the default exceeds the default of a given stablecoin exceeds that number, the losses would obviously feed into the senior holders.
absolutely.
So is there a way is there a way to mitigate this? Is
There are ways we're thinking of mitigating. For the way we've modeled it out is for sure there's going to be protection for so whatever the largest allocation in the basket is, let's say it's 15%, that will be, or that's what the system will strive to provide as risk holders, 15%. But again, one of the things you need to remember is even if something is expelled, it's more than likely it's not going to go to zero. So Tether something dramatic could happen to Tether, it's unlikely that it would trade at zero. It might trade at 50 cents. So on the one hand, you do have a certain cushion where it's unlikely where an event in which only one underlying asset is affected that it would go to zero. But let's say it does. And you have a situation where there is a loss of peg in another coin. Again, let's say one of the coins has an allocation of 10% and it loses 20% of its value, then everyone else is going to take a 2% haircut. But there are ways we're looking at mitigating that, which start getting more complex, and that is taking a certain ratio of the underlying assets and lending them out, and the ability to earn interest on that. That is very hypothetical at this stage, because you start running a whole host of new risks once you start lending out any of the collateral. But to answer your question, in an event where there's a loss of peg for more than a couple of tokens, then there's no way that the senior token holders can avoid a haircut. But it's likely that haircut would be minimized a lot more than a situation in which they were holding only one stablecoin.
Yeah, I mean, I agree. I mean, if it's designed in a way such that the number of the percentage is lower, I mean, you obviously need to take into account the recovery rate. But then again, anything is possible, right? So,
Yeah.
especially with such a short history. Thanks.
Any other questions? I think we'll do the last one because we're running on time. There's one over here.
Assuming that you're using RBTC for the bridge,
Sorry?
RBTC and RSK for the bridge between, you know.
Not necessarily, but
Okay.
yeah.
So there's two questions there. I mean, if you're using RSK, in terms of like gaining traction with the crypto community specifically, what barriers do you see around transparency and centralization, you know, with the federated nodes and that kind of also not being very public to the general community? And then the second question from that is, with something so technically complicated, what challenges do you see the DeFi space having to overcome in order to get wider peripheral traction with people who necessarily aren't familiar with these protocols? What would you say is maybe the two main things that would need to be kind of tidied up before that happens?
Two good questions. I'll keep the answers relatively short. So for the first question, I think what RSK and Bitcoin in general needs is a killer app, just like Ethereum had a killer app. Complexity is not going to play a role in this. Maker is an extremely complex protocol, but also extremely successful and popular. I think what you need is a killer app that answers the use case and has that market fit at the time. For MakerDAO, it was the ability for people to leverage their holdings on chain. I think the same thing is true for Bitcoin. It's still the same type of users. And if you have a Bitcoin-backed stablecoin that is decentralized, then you're going to see the same sort of usage. So obviously there are technical barriers, but in that particular case, I think it's more a matter of finding the right use case or the killer app than the technical solution. With regards to the masses, I think, you know, onboarding more crypto users, people have a lot of answers. I think the bottom line is that it's only going to be mass adopted when people aren't even aware that they're using a crypto solution. So one of the things we've been focused on for a very long time, and we've had a certain amount of success with, is, for instance, having a bank start issuing stablecoins through the system. Now, what does that mean? That means that you're the customer of that bank. You have an app, and that app shows you have $200 because you gave the bank $200, and now it's showing on your app. Everything makes sense. Everything's exactly the same as it always was. But now that bank, what they're doing is they're tokenizing those dollars, and they're sending those dollars into Cement, and they're getting back this. The stablecoin that you get, this kind of super stablecoin. They're putting that stablecoin in your wallet, and they're calling it dollars. They're not even calling it crypto or anything like that. And then another bank is doing the same. A bank in Malaysia, and you're a bank in the UK. These are two ERC20 tokens. I can send them dollars. They can send them me tokens. They sent me $50 like that. Now I go to my bank and I want to withdraw those dollars. So the bank takes my ERC20 stablecoin, sends it back to Cement, redeems those tokens for their stablecoin, burns them, and gives me dollars. Now, what's the thing that is, in my mind, the most interesting aspect here? That bank did at no point relinquish custody of its own stablecoins. It held them, and then they were locked in an auditable on-chain smart contract. They weren't sent across any borders. They weren't given to any other bank. And the reason that we've designed the system in that way is because banks were telling us, we simply do not have the capacity to send our stablecoins to another bank or to accept stablecoins from another bank. If you can solve that for us, if we could lock them in a way which we can audit and we could have control and we could redeem for them at any point, then we can talk. So I think it's two parts. It's one, it's the convenience of the user, letting them use crypto in a way that they've already used everything and not even have to worry about. And two, it's how do you find the ways, whether they're regulatory, whether they're technical, to embed yourself where the users are. And the users are still in banks. That's where the money is. That's where KYC is done. I think crypto is going to do a lot of things in the future that are going to extremely and fundamentally disrupt finance as we know it. But before we get there, I don't think there are many ways around still having things like KYC at the gateways and at the endpoints. But if you can create a decentralized way that allows people from different gateways to interact, then I think you're building something that will be able to scale. Great, thank you all very much.